The June FNB house price index quickened to 2.6% year-on-year from 1.8% in May. Here to analyse the numbers with us is Ewald Kellerman. He's property analyst at FNB Home Loans. Thanks so much, Ewald, for joining us today. Well, we've had the price index show a slight acceleration, as I said, to 2.6% year-on-year from a revised 1.8%. While that looks encouraging, if you're looking at, adjusting that to the growth rate with inflation, you've got real house prices having declined at a rate of negative 2.5% per annum. So what picture are we really looking at here?
Well, the positive house price or the acceleration in growth is definitely a very positive sign for a household sector that hasn't seen growth in property prices for quite some time. But on a real basis, as you mentioned, unfortunately, it's still under a lot of pressure. CPI is currently at 4.6%. So a lot of prices a lot of pressure on real house prices and eventual decline. The problem here is that it's a very sensitive household sector with a very highly leveraged credit position. So any interest rate movements up or down should affect it quite a bit. And we've seen from the cuts that ended in November last year that it provided a bit of stimulus to the market, and that's where we believe the current 2.6% nominal growth comes from. But we don't expect that to continue for a very long time.
Exactly. While we've got that lag effect, by now taking hold, with that effect wearing thin, with no more rate cuts seeming to be on the agenda, everyone most interested in the sustainability, as you said, of this upward trend that has come through.
Yes, I think from a sustainability perspective, we're definitely not expecting much in terms of house price growth for the next couple of years, in fact. A high debt to disposable income level is a very difficult thing to grow away from. It can't be grown as quickly as we grew the credit levels when interest rates structurally adjusted downwards. So to summarize that, we don't expect a boom in the next couple of years. And with interest rates looking to go up later this year, there might be some bad news again.
Let's take a look at the supply-demand dynamic that's out there and what we're actually looking at when it comes to the kind of activity we're seeing.
Yes, of course. In FNB, we look at we created an index called the Value as Market Strength Index, and what that essentially tries to capture is it quantifies the demand and it quantifies the supply for every valuation that we do, and we build a confidence index to show what the supply levels look like relative to the demand levels. And while supply has stayed fairly constant over the last 10 years or so, the demand level has dropped substantially with the pressure on the household sector, causing a very highly oversupplied market.
Has those home price expectations, because that's always a factor to consider when you're looking at the supply side of things, whether those that are selling their houses have heightened expectations that are just simply too unrealistic to be fulfilled?
Well, it's a very good question. I think we've seen a lot of the unrealistic expectations from prices from sellers in the market. Our second quarter estate agent survey captures this quite nicely when we look at the average time property spent on the market, which is up to just over 15 weeks. And 9 out of 10 of those sellers, according to our estate agent survey, have to drop their asking prices. So a lot of pricing unrealism in the market, and a lot of people have to adjust their expectations downwards to eventually get their property sold a couple of months down the line.
And one would assume that leading to sellers holding on then for a little bit longer in the hope that things will get better, that the economic outlook will improve, or the economic picture will improve. Do you see that supply-demand dynamic shifting in the near term?
Well, I think it is a very good case to hold on your property before selling it when the market is a little bit more healthy. The problem is that realistically a lot of people can't hold on to their properties for very much longer. Of the sellers, the total sellers in the market, our estate agents report about a quarter of them having to sell to downscale due to financial pressure. And that's definitely not something that you can delay for another year or two. So if you do have the luxury of doing that, you might fetch a better price a year or two down the line. But at the moment, unfortunately, with a heavy oversupplied market and people having to sell, we don't expect much from a demand and supply perspective, and definitely keeping that pressure on the prices.
Within the home loans division, what kind of activity or impairment rate are you witnessing at this stage for the average South African?
Well, unfortunately, I can't speak to the exact numbers, but I can speak for the market in general. And the impairment numbers have definitely definitely hurt the bank's balance sheets quite a bit. It is a very large part of the bank's balance sheet, and we've seen that across the entire mortgage industry, that there's a lot of pressure on those prices. The low interest rate environment is definitely helping. So we've had a very good year or two. But the problem is that stimulus doesn't come from low interest rates. It comes from interest rate cutting. And people already in a bad financial situation, who might have experienced job loss or loss of income, is still under a lot of pressure and still having their home loans in arrears.